Hey, everybody. Welcome back to another episode of Stage Debate with Cossack Isaac, the only platform that has real estate investors discussing relative topics on a debate style stage, hence, Stage Debate. My mission in life is to help real estate investors just like you not pay any taxes using their investment properties to offset their partners and their investors' tax liabilities. Reach out to me on LinkedIn today to learn more. Welcome to episode number 1 of Stage Debate with Cossack Isaac. It's a pleasure to be here tonight with some amazing folks. We got Jeff Sherman from FSO Capital Partners. We got Garret Lynch from Nighthawk Equity. And we got Mike Woodfield from Obsidian Capital. All amazing guys, which we'll introduce in a second. Just this is not something we're going to do every time, but this was a vision that's been in the works for over a year. There's been many times that we wanted to implement it, and the people that helped me get this going told me to wait for the perfect moment in terms of this happening, that happening. There's a lot of puzzle pieces that had to come together. This is going to be next level. I have yet to see a podcast. I've seen similar stuff that has more that debate style with a few big time guys on there. This can be super interesting. Appreciate you guys coming on this late hour. And I'm excited to talk to you about boosting NOI, a little bit about your journey, and a little bit of advice, what you would give to a lot of the fellow guys starting out. So first and foremost, this wouldn't have been possible without our corporate sponsor. Our corporate sponsor is a man by the name of Michael Stern. He is a genius tax guy in real estate. He has a company called Line Star Tax and LST Consultants. Definitely somebody that you listeners should get in touch with. And our episode sponsor, Purchase Pro. Purchase Pro is a pretty cool idea. If I'm pronouncing it correctly, it's an e-procurement platform that offers a range of benefits, including the ability to compare the pricing from multiple vendors, advanced technological features such as analytics, approval processes, and bidding tools as a convenient one-stop shop approach. Pretty incredible. Thank you so much to the Purchase Pro guys, to Michael Stern and Line Star Tax, and to all the listeners. I appreciate that. Okay, so hopping right into it, we have a few awesome guys over here that have done tremendous things in the real estate space, starting with Jeff Sherman, principal and co-founder of FSO Capital Partners. He syndicated hundreds of millions of dollars of real estate and has much of that under management. Before founding FSO Capital Partners, Jeff was the executive vice president of multifamily at Colliers International from 2007 to 2017, where he headed the number one firm's multifamily team nationally. Jeff brokered over 250 multifamily transactions throughout the Southwest and well over $1 billion of valuation. So that's pretty incredible, Jeff. Honor to have you. Garret Lynch, I've seen you around and you've done tremendous things. Also, Nighthawk Equity, hundreds of millions of dollars under management. The age of 26, so that's pretty young. Anybody could do it, guys. Just got to have the brain power and the willpower to do it. Age of 26, started in D-class Section 8 properties on the south side of Chicago. So that takes a lot of guts to do that. There's a lot of stuff going on there. Then went on to C and B-class properties in 10 different markets, building up to 3,400 units, which is pretty incredible. He then went on to co-found Nighthawk Equity with roughly $300 million under management. And the boys definitely know Garret. He's been doing beautiful stuff in the Alabama and Georgia markets. Mike Woodfield, a longtime friend of mine, partner and co-founder of Obsidian Capital, an investment firm based in Texas. 2,000 units under management. I think it's a lot more than that, but 150,000 square feet of flex space, developed close to 1,000 units. So just doing a beautiful amount of things and constantly doing things. I think you're under contract and a bunch of stuff. So it's super, super impressive. Um, so thank you guys. Um, it's an honor to have you on. So today's topic is an interesting topic. It's something that people talk about all the time, but coming from people like you, I think it's important for our listeners to truly understand what you guys do on a daily basis to boost NOI on your properties. There's so many different ways to boost NOI in your property. Obviously, the first way is revenue increases, organic rent growth, switching over units, forced appreciation. But then there's the second part, which is cutting costs. Um, I believe, and you guys know a lot better than me, but in the little that I do know in real estate, and you guys will tell me if you agree or disagree. Um, Revenue increases and revenue growth is probably more important than just cutting costs. Cutting costs are obviously very essential, but the growth that there is in revenue increases, and there's so many things that we'll talk about that I did some homework on and jotted down. Um, so there's really two avenues over here. So let's start with Jeff, if you don't mind. So obviously, again, you've been in the space for a while, and on a day-to-day basis, you're involved in your properties when it comes to boosting NOI, and obviously there's so many chapters in that book. What are the first things that come to mind? What are some misconceptions that maybe you would think that you see real estate guys around think that they're going to go spend time on, and really they're really misplacing their effort in a certain area. Um, and yeah, just your thoughts on the idea of just boosting that NOI and really getting each apartment to produce that extra dollar, that extra $10, because obviously 10,000 units is going to make a difference for $10 an apartment. Go for it. Go for it, Jeff.
So yeah, I mean, I think that it's really important to understand the context of the market that you're in. A market could be going up, down, or sideways, and so you really need to let the framework of the market direction like interpret and inform that decision. 3 years ago, it's really important to push rents. We were seeing crazy rent growth, even 2 years ago in my market. That rent growth is now turned negative, flat to negative, and so as I'm trying to put that into context, what I'm most focused on a daily basis is how do I keep tenants in place and how do I lower my turnover cost? And so some of the things that we've done recently, well, I'll back up a little bit. I think it's counterintuitive, but if you're just focusing on today, let's just say, for example, I can push rents, $50, $100 on a unit. So $100 is a $1,200 rental increase, but we recently did analysis of our portfolio across our 1,500 units. If we turn a unit over, we're at like $3,500 cost between the lost rent and the turnover cost, like the turn on the unit. And so it's actually better for us right now to keep the existing tenants in place, even if there is quote unquote a positive lease trade out. And so what we're doing in that context is twofold. I think that if you really want to know what someone's going to do, I think I'm borrowing this from Charlie Munger, just look at their incentives, right? So from an incentive standpoint, we're paying higher renewal commissions to our leasing staff. So now they're way more focused on renewing existing tenants, and we're paying concessions for existing tenants to renew those leases. If we can cancel out that, even if we can take, let's say a building has average turnover of 60%, if we can bring that turnover down to 40%, we've saved quite a bit of money, and that will reflect positively in the NOI. And I'll just add one more thing. Up to probably the last 12 months, and I can't speak for all the markets, all I know is mine, the play has been to be in and out very quickly. Well, now we're in such a situation that, interest rates have dictated that we need to be holding these buildings longer in many cases. And so it's even more imperative because in many cases, either interest rate costs have driven higher expenses below the, NOI line, and B, you weren't planning to hold a building very long. And a lot of these deals, particularly like 2000s and older construction, a lot of the expenses are actually buried below the line as like quote unquote replacements. But I mean, they just happen every single month. And so it's super imperative to really try to lower that turnover as a means to boost NOI.
No, that's super interesting. It's actually a interesting view. Um, I want to ask you before we go on to Garret, in terms of, let's say, obviously RUBS, ratio utility billing system. In terms of people do on-site storage, people do sometimes, believe it or not, short-term rentals sometimes in certain units to bring up and leverage things out. Are there any of these things that you've creatively implemented in any of your properties, or it's just the standard turnover units fast and the classic things? No fancy ideas.
Oh no, I mean we we have rubs in our buildings. We try to recapture 95% of our utility costs through rubs. Um, One small item that you can really push are kind of fees, application fees, recurring fees. We also institute renters insurance, which you can work a little arbitrage on that, even if you're not insuring yourself. Um, those are some of the strategies that we pursue on that end. I think for us, the vacation rental model has not borne fruit. We have a building in Prescott, Arizona, which is pretty popular for vacation rentals, and it was pretty much a wash for us in that respect. And I think the market got oversaturated in Phoenix. So yes, we do institute other strategies, but I think right now we're just in a bit of a knife fight as it relates to keeping tenants in Phoenix. 20,000 units are going to deliver this year, and absorption last year was 12,000. It's going to be the same thing next year, and so while I do think those incremental increases, in other income lines are super helpful, I think you could miss the forest for the trees if you're not focusing on turnover.
Very interesting. Very interesting insights. Garret, let me ask you like this. Um, what are some creative things that you've done to boost NOI? Obviously, a lot of people do the same things, and I want to hear your specific take on rehab. When you go in and you try to value add a property, people try to do in-house. People try to get the cheapest guy. At the same time, people don't realize that turning over units super fast is really where the money's at.
So we turn. I mean, when we were peaking, we are probably turning maybe 80 apartment renovations in a month across our sites, and so we've had to really dial in our process. Right now, so in the prior environment, it didn't really matter what you were spending on the renovation so much. I mean, obviously it always matters, but you're just getting crazy rents. So you're like, all right, renovate it to the nines and get a $500 rent bump or whatever it was. Now you have to look at the return on investment. So what we do is, and this, I had a buddy that taught me this, but you basically look at what you're spending on the apartment and then look at the rent increase that you're going to get from that renovation over a 12-year period, and it has to be 15% or greater in order for it to be worth it. You can also set your own thresholds as to where you want that to be. So you can kind of back in the numbers. So in a declining market like right now, a lot of our scopes of work have dropped on unit renovations because it's just not worth it. Why should I go put granite countertops if I'm not going to get the return on it? And I can't really see too far into the future to guess, so I'm not going to spend that money now. When I can get a rent bump that's 250 and get Formica countertops with refurbished cabinets, something like that. So that it's shifted a bit as far as our strategy there. But as far as like, first of all, I'm going to debate you, Isaac, on rubs being a fancy thing because it's not fancy. Rubs is just something everybody has, but fancier things. I mean, we do like a package locker system that we wrap, that's got the brand on it, that we can either bill people for or not. Um, we'll add a bunch of amenities like a hammock park, um, a bigger dog park, like just different things like that, and then charge an amenity fee to people. And sometimes people like it, sometimes they don't. I don't really care. Um, if the most of the community likes it, we go for it. And then you've got, I mean, you've got like a really simple one is if your property has just like washer jar connections, you can throw the washer jars in them, just buy them for the whole site, and then upcharge there as well, as long as it all makes sense and you can get it.
No, that's a good point. And I speak to a lot of real estate guys, and one of the big guys said exactly what you were just saying just now, that rubs is the fancy lingo when it comes to boosting NOI, but at the same time, there's so many different creative ideas, and like you just said, and you add these different amenities, and you charge a little bit for each thing, and that really adds up. Um, and yeah, obviously bumping rents by turning over units is important, and obviously not taking too long. Sometimes I have clients that I see that their units just stay vacant, not because they don't have good leasing brokers that could find people, because they're just not ready. And so obviously that's important. I'm not taking away from that. But like you said, these creative strategies of adding these amenities that you do, it's cool, and that's something that I've looked into and have seen. And people, there's different creative ways to charge for parking. Obviously, you don't want to rip off your tenants. You don't want to get them upset, but there's ways to do it in certain environments and certain demographics. Charge for parking. There's a laundry hack like you were talking about.
It's market
Um,
dependent too, Isaac. I mean, like you can go to Arkansas and everybody wants a washer dryer, and so it's easy to charge for that. And then you go to Texas and there's something else that the market really wants, and then you give them that. Or if you're not on that level, you're not providing that, then you're below market, right? So you really have to kind of understand your location as to what you can implement also.
That's really true what you're saying. Something like Rub, something like turning over units fast, that's something that's going to be universally the same when it comes to these amenities, when it comes to certain things, parking, laundry, all those things. Like you said, the Arkansas guy is not going to be the same as the Texas guy. So knowing your market really, really well. That's. I'll end off with a question for you, Garret, right now. When you were in 10 different markets, this really goes to somebody that is in multiple markets, and I have clients that do buy in multiple markets. I know Mike, for example, is a big Texas guy, but he's looking at stuff in Alabama now. So um, I guess I know the answer, but you got to know those 10 markets the same way you know your one market. That's the idea,
Well, you
and that's
can't.
probably pretty hard.
You can't. That's the
It's not
problem
possible.
with that model. It's not the same unless you're
What's the
really
limit? What's the limit?
for markets.
Yeah.
So I've done it both ways. I went wide and then I went deep. The first business was wide, and I didn't. Had some good sites and some really bad ones because I didn't really know my markets that well. Just being completely blunt about it.
Right.
Um, and I don't think I would do it the same way. So I didn't. So we went deep, and now I know these two markets that we're in block by block, and it gives me it just lowers the risk. Now I don't like to go and change anything if I don't have to. And going into a new market, setting up shop, figuring out who are your vendors, who are good, the good management companies, who are the bad ones, who are what's the right block to be on and not, like all those things. That takes years to really understand. And if you're
100%.
investing with someone that knows the market like that, your risk is lower. That's just what it comes down to.
I totally hear that. Somebody knows their market literally like their backyard or like their playroom. They know every single vendor inside out, and obviously it's easier to cut costs there. You really know what you're playing with. So, Mike, I'm going to nail you after we talk about what your take on how you really up up the dollar, the NOI for each and every apartment building that you have. I want to ask you about those two different markets that you're in. But first and foremost, Mike, what's your take? What's your take on specifically multifamily? I know you're involved in Flex as well and development as well, but specifically the multifamily that you have. You guys have thousands of units. What unique things do you do to implement? Obviously, again, everybody's going to have similar ideas. Are there any unique things that you do to rake to rake in the income over there?
Yeah. You know, what I like to do when I'm looking at a deal or analyzing a deal like these other guys have said is, you got to know the market you're getting into and what those tenants are looking for. I mean, it's really important that whatever you're trying to sell them is something they want. And I've found that the best way to boost your NOI right now is Jeff alluded to on the rental income. It's a little tricky because you're not really getting the return by moving someone out and putting a new tenant in. So it's almost better just to renew them at just where they're at. and save on the term and cost. Just keep them happy and keep them there. So we have the same objective of keeping our renewal rate really high, whereas before at 50%, we were kind of happy because our trade outs were through the roof. So, as you work down the income, you get to the other income, and that's really where I've focused on, is on other income. And as you dive into other income, RUBS is, not common across the board. There's a lot of all bills paid properties out there, but that's something that you could implement if the market dictates that. I would say look for things that people are already paying for and see if you can make money off of them. So one thing we've done is across the board we've signed bulk cable and internet contracts, and the return there is fantastic. In the first year, you get a per door fee, so you get an upfront fee of usually $100 to $150 a door, and then they usually sell you at between $30 and $40 a door, and then you resell it between $65 and $80 a door. And we found that most of these people, 90% of the tenants say are already using Spectrum. So whether they're paying Spectrum or us, it doesn't matter. They're going to have internet. So you go on and you can negotiate with Spectrum or AT&T, and you can, start making a lot of money doing that. And it's tricky to navigate through operationally, so a lot of people don't do it. And what happens usually is you sign up for it and then you don't implement it well on the property, so you end up spending more money than you make. So it's something you really have to keep the foot on the gas for. But on all of our properties, we're making a great amount of money on cable and internet, and it's something that they would already have. So it's not really like an amenity fee that they don't give a shit about, or some of these other things you just shove down their throat. I mean, they use their internet, right? The other thing that we've had a lot of success on, and it's already mentioned on here, is washers and dryers. Yet another thing, you've got to wash your clothes, whether it's at a laundromat, at the facility that's on site, or more preferably inside your unit. So on all of our underwriting, we just bake in a certain amount of money that for washers and dryers, and we implement that over the first year or two of owning the asset. And we get anywhere between $50 and $65 a month on those washers and dryers, depending on the market. So we've had a lot of success with that. But I mean, you can fee these people to death, and whether you're pushing the rent up or you're just overfeeing them, it's all the same to them. You have to actually provide value, or you're going to lose them at the end of the day. So, I mean, really, I'd be careful on how many fees you add on top of the rent. I know that we have the highest increase of fees we've ever seen, alongside of the highest increase of rents we've ever seen in the past 2 years. And eventually, these people say, "I can't afford it. I'm out." So it's a very tricky balance, and that's why most people are being pushed down to expenses now, because we've reached that ceiling where it's like, too much, guys. I'm moving. And so that's why everybody has the tendency to move down into expenses and start cutting there, because they're not willing to think through and be creative enough on how do I grow that top line without killing my resident. And I found find things that they need, or, that's an option to them, like parking, right? You don't force it, but you could say, hey, we're going to have reserved parking spots. That's an option, right? And if someone wants to pay $50 a month for a reserved parking spot, it's available, right? So rather than like overarching across the board, you have to pay this fee to be here, So I would push back a bit on doing that right now specifically, just because it's a balancing act out there. And I know that Garrett's in Huntsville and Jeff's in Phoenix. I'm in Austin. All these markets are overbuilt. We all are dealing with absorption issues, and you got a Class A unit down the street that's giving away 4 months free rent. You can't dick around with these people and expect them not to leave when they lowered their qualifications to 2 times the rent so they could get people in the units. They're trying to refinance out of their construction loans. They don't care about you, so they're going to do whatever it takes to get someone in their doors. So, I would say be careful about your increases and be thoughtful about those, or else you'll just be bleeding out in vacancy. So,
Yeah, I'll just
Super,
echo
super
that for a
interesting.
second.
Yeah, go for it, Jeff.
So, we're dealing with, as Mike described, an environment where new construction, multi is delivering. I'll give you an example as to an analysis we're running currently. So, you talk about boosting NOI. NOIs are eroding, and so you almost need to think about it as like, holding it back and preventing a decrease in NOI. And so, how are you going to position your building to go down the least as compared to your peers? And we've got a building 2020 construction in Prescott, which it's a good market. It was the nicest building in the market, but there's about 1,000 units delivering in the market over the next 2 years. And so we're like, okay, how are we going to be able to compete with these lease ups? We obviously can compete on price, of course, but one thing we're likely going to be doing is installing, technology and smart home packages just as a means to, make the product as good, if not better, than the new deliveries that are, 4 years newer product. Maybe we can do that as an incentive for people to renew, or maybe we can just install that across the property as a means to provide a better product to the market. And these smart home packages do come with expenses that we're pushing back onto the tenants. There's maybe a little bit of arbitrage there, but it's more used as a means to prevent existing tenants from moving to the new building down the street with a big concession, and as a means to compete with these new lease ups. And so I think that's something that is going to be a challenge.
But should you compete with the lease ups if you got like a middle of the road site? So like,
It's pretty nice. It's 2020 construction.
oh, so you have a newer one.
Yeah.
Yeah, we're buying a site that's got it's the only B minus asset and everything around it is A class. And so we're kind of like niching right in the middle of it. And we're just gonna own that specific part of it. But if you got a newer site and you've got new deliveries coming in, yeah, I can see how you need to upgrade that.
I will say with what Jeff said, if you're making your NOI stagnant right now or slightly growing it, you're doing fantastic.
Yeah.
With taxes and insurance, just killing everybody, as well as inflation's hitting payroll. Just these people need more money to live. I mean, their rent's going up too. I pushed a lot of our employees to our sites to live there because of that, because we're able to kind of control a little bit on cost payroll, and those units would probably be vacant anyway. So, I mean, it's a dogfight out there, and I would say if you're on all of our underwriting, we're doing our new acquisitions. We're saying in the first 2 years, our NOI will be lower than it is on the T12 we're underwriting off of, just because it's just what's happening right now. We're kind of near the bottom and like kind of in the trough, and projecting that we'll go out into another bull market. But I mean, you've got to be realistic with your valuations here, especially if you're buying right.
I mean, that's really an interesting question, though. Is how are you guys projecting the future?
Well, you can't. You've got to assume that history will repeat itself, and that the market will bounce back and appreciation will be in play. We do know that there's 5 million units. We're short 5 million units in America, and that more and more people are moving here by the second. So the shortage continues to grow as the Treasury has held stagnant and the Fed lending rate has not moved a freaking inch. People are not buying and they're not building new homes. And so I think the only conclusion you can reach is that rents have to go up because we still have a shortage. It's just supply and demand. Unless everybody continues to move in with each other like they did in '08, which we're seeing a little bit of right now.
Or people will just settle for less. The B plus guys will just stay in the B properties. The B minus guys will stay in the C plus.
Yeah, well, they may move down. Yeah, and that's why we've always bought B minus assets, is because we thought we would capture those people in the A properties. We've always looked at workforce housing, but I mean, Garrett, who freaking knows, And I mean, you
Yeah,
just got to make
that's how I
assumptions
feel too.
before. Yeah, I mean,
I think I'm doing the right thing by buying right now because it's down 40% from where we saw the defined peak was, but I can't really forecast it that well.
Yeah, it's really challenging. I mean, an environment where you can look at the price and you say to yourself, "Wow, that sounds like a good deal. It smells like a good deal." You put in a model. You're either zero or negative rent growth for 2 years. What kind of cap rate are you going to project exiting at? It's difficult to put in a book that you're going to sell for a remarkably lower cap rate than you're buying, and you're borrowing at a high rate, and so you don't have any levers inside of the model. From a medium term perspective, it's likely to do exactly what Mike is saying, which is rents are going to come roaring back due to the supply and demand imbalance. But like in Phoenix, for example, and in all your markets, short term, too much supply. And so, I kind of think of it as like the Oregon Trail. I don't know if you guys remember that game from like, growing up as a
Great
kid.
game. Yeah.
We're on a raft. We're trying to get to the end from one side to the other, and we're trying to navigate that. And we know there's better days ahead. So it's just getting from here to there. That's kind of the game that we're playing. And I agree, it would be a great time to buy if you can find specific situations that.
Well, I
that
think the
live
lever,
well.
I think the lever, Jeff, in your underwriting is, does it cash flow when you buy it?
For sure.
That's the lever. Do you
Yeah,
have cash flow coming in?
but maybe it's not because someone gave it back to the bank, and then you
Sure,
have
then maybe you're a price per pound play. Maybe you're buying on a low basis and you're hoping for a better day, but that's still risk. If
like,
you're buying,
are you guys buying with bridge loans if you see an
no,
opportunity like that?
we're buying loan assumptions. That's all we're buying right now. We're buying loan assumptions that have 8-9% cash on cash in year one with no rent growth, because we know that works right now.
Yeah.
Aren't you? If you do that though, there's an argument that at a higher price point because people know they can get more.
Usually
For
they're
the
sold
loan
for a
assumption.
premium. Generally, the loan assumptions are sold for a premium.
For,
Mike, what do
for
you say about that?
For sure, yeah. I mean, we're getting a little bit of a discount on a cap rate. Like we're buying right now that's north of a 7 cap in Alabama, and it's a fixed 3.65% loan, but we have 10 years on it. So back to your question, Garrett, what happens in a decade? Do I think that maybe I paid $10,000 a door too much given the market? And I wouldn't have paid that much if I had to go get new financing. Do I think in 10 years I'm going to sell it for more than 10,000? Well above what I paid for? Yeah, but I'm going to enjoy the 9% cash on cash.
I don't want to own any property for 10 years.
Why?
I get sick of them because I get sick of them. So it
No,
depends
but
on
you see,
depends how
Garrett,
you're operating them, I guess.
Broker's
But-
going to love you, bro. All the brokers listening, Garrett's your guy.
Boom.
this
Look at this one.
this is
Get it away.
navigating into a whole nother conversation, but many syndicators have that 3 to 5 to 7 year exit strategy. But guys, we're coming up on time. I want to get towards the end of the show. There's one more question before we get to the end of the show. There's going to be a lot of newbies listening to this podcast, and they could definitely learn a lot. So I want to start with Mike. Mike, what was, just in short, let's keep it to a minute or two, any sort of turning point in your career? It doesn't have to be anything grandiose. And what piece of advice would you give to a new guy starting out? Because obviously there's a next generation.
Yeah, when I first got going, I actually was just in asset management. That's where I got kind of cut my teeth. And a property that I was asset managing on was in a tertiary market, completely dependent on oil and gas, and the freaking tide went out, and the project fell to 65% occupied, and it got foreclosed on, and I went through that full process of getting forbearance and the whole foreclosure, giving the keys back to the bank, and I saw the ownership group that was going through that at that time. It was an agency loan. Thank goodness they didn't have to, give any of their personal belongings along with the keys. But, seeing the pain that caused them and their investors, and honestly, they just underwrote the deal too riskily, and they didn't have much in reserves, and it just all hit them at the same time, and it made me realize, man, like, these don't always work out. And, when I buy my own deals, I'm going to make sure that I'm damn certain that I've done everything I can to keep these properties afloat, through the hard times, and I'm going to buy right. And, that company I worked with, we were buying like 15 properties a year. And now my partner and I, we buy 2 to 4 the past 4 or 5 years a year. And, it's because we're just very picky and we're very conservative on our underwriting. So that was an aha moment. There's about 10,000 other ones I could share with you, but that's a big one that stands out. And for anybody that's getting going in this industry, none of us are free from risk here. We all put our names and our reputations on the line every day. And if you want to do it, you got to go do it. You got to just jump in, and it's as simple as that. You got to have some cojones, because this is a high stress. Not everything goes perfect, and you got to figure things out. So, but just have the guts to know that you can make it through hard times and you can get it done. So,
Love it, Mike. That's I love it. Beautiful, Garret. Um, Turning point in your career that got you going, and some advice to some new guys.
Yeah, I mean, I would say in the beginning, if you're getting started, it's easy to look at the low hanging fruit. What I mean by that is a deal pencils really well, but it's in some tertiary market that you don't know, and you're like, well, this is my first one. I'm going to go for it, which is kind of what we did in the beginning. And I wouldn't say that I regret it, but I just think that there might have been a better way to start out versus going to the low hanging fruit and thinking that I had all this cash flow from these hood properties when there was no equity in them. And so if you're getting started, sometimes you can look at that and say, that's how I'm going to get in, is I'm going to go buy this junker or whatever. You'll learn a lot, but it's going to be a lot of pain. And you'll soon realize when you finally get, there's all this this aura about raising capital and finding deals, and it's all this like sexiness, but people don't talk about how hard it is to actually own these things. And it is absolutely, um, like Mike said, extremely difficult, and you have to be able to take a punch. And just like any entrepreneur, you're buying a business. It's a business. It has employees, but you have another layer of humans that you have to house, and these are where they live, and they take their housing seriously. It's the most important thing to these people, and so you have a lot of people involved in these assets when you get in, and you have to know how to navigate that stuff.
I love that. Actually, one of my favorite points of the night, Garret. You really nailed it. You see on LinkedIn, you see all over people talking about, hey, I finally got this deal closed, and I had to raise capital, and I couldn't sleep because until the last week, I couldn't figure out the last $1 million in equity. Now I closed it, all is good to go. The work is only getting started right now, and people don't see that, and that's a super important point for guys starting out. It's not over when you close. It's over when you exit, and it's not over then either. Go into the next market, next property, and keep going and make your investors happy, keeping them happy, keeping your tenants happy. That's very, very important. I appreciate that. Jeff, last but not least, any turning points in your career, and what advice would you give to the new guys?
Yeah, I mean, for me, I was, pretty successful in brokerage. And at one point, there was I saw a book that one of my clients was putting out to raise capital. And in that book was like half of my OM. And I'm like, wait a second, that's my pitch. That's what I would do. And they're saying they would do it. I feel like I know as much, if not more, than this person. This person ended up, moving on to owning tens of thousands of units and being very successful. And so that just kind of gave me the push to say, you know what, I can do this. This is something I'm capable of doing. This is not rocket science. In fact, it's just really hard work and blocking and tackling. Thankfully, I'm good at that. If it was rocket science, I wouldn't be doing it. So I think that's really encouraging when you can finally, really have that confidence. And so that was a big turning point for me. In terms of advice, I would really tell people there's always, I think in starting in this business, the biggest the biggest concern that folks have is, how can I raise the money? You never know if you can. You don't know if you have enough. And I would just throw that to the side and just focus on finding really great deals. And there's a million ways to find great deals. If you find a great deal, the money will come. It will find its way to you. And I think if you're getting started, I just focus a ton of your energy and time developing relationships with good brokers in the market. And, you know, as a broker, I knew when I got a really good one, I would only call a really short list of guys. And obviously getting on that list is difficult, but figure out any way you can to get on that list. And I think that will end up paying in spades. Then you'll raise the money, then that deal will do well, then you'll get referrals, then you'll raise more money, then you'll get more deals. And it really just starts with finding good deals. So I'd focus all your efforts, in that.
That's impressive. I love it. All the brokers that I have relationships with, I think that there is not every single syndicator, not every single owner was a broker, but somebody who was an esteemed broker definitely has a little bit of an edge to start off with, knowing the ins and outs, knowing how sellers really work. That's super impressive, and you're right. It's something I tell people all the time, and I try to help clients out connecting the dots with raising capital here and there. And we all know it. If your deal pencils, if it actually pencils, if it's a good deal, and you're not some corrupt man, the money will come. So obviously in the beginning, bring on somebody that has a little more experience, that has some sort of track record, but definitely all great points. Guys, I'm super thankful to you. You guys took out time of your day, time of your night. Garret, you could have stayed in the gym longer. Mike, you could have been having a good time. Jeff, you could have been playing some ball. So I definitely appreciate it. To all the listeners out there, you could check up these guys. I don't have to sell these guys for you. These guys put together beautiful deals. They have a long track record of doing successful deals. If you're looking to invest, get in touch. Thank you, everybody, for listening to this awesome episode, the first episode of Stage Debate with our awesome guests, Jeff Sherman, Mike Woodfield, and Garret Lynch. Drop a like, drop a follow, subscribe, and stay tuned for future episode drops. Thank you.